Hello, my name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective channel, where I help you make your dreams a reality. Now, if you've seen any of my previous videos, you know that I love strategy and targeted strategy. That awareness is key because I'm going to keep sifting these financial memes, uh, using our investment strategies along with some everyday down to earth common sense. And memes, emails, just online content. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a financial strategist. And I'm going to be talking about our closed-end funds system today. And every time I show or reference closed-end funds on the overall meme videos, it's it's a challenging video because I want to address what's in the meme, but I also want to compare that to our financial system. And it ends up meaning, I mean, honestly, it ends up with me having a lot of tabs open and showing a lot of info. So I hope that it makes sense. I hope this is not confusing. Um, as I make these videos, it's not my intention to slander anybody. I'm interested in separating the good from the bad when it comes to financial advice, because none of us want bad financial advice as we navigate our finances. So, the easiest place to start. Hmm. 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 You have a plan and then it kind of changes as it happens. So, easiest place to start is, let me reference a video I made on June 30th. I gave a ton of information on the closed-end fund side of things. So a lot of this information comes off of that video, but I'm not going to give you the whole video because it would just make this one incredibly long. So the snippets that I want to mention. So when it comes to investment into the market, you have to know the herd's location. You need to know your strategy and your overall game plan, but you have to know the herd's location because the herd will jack prices. So, where's the herd right now? Technology. The big three: Apple, Microsoft, and NVIDIA. And you could say it's the big five, or maybe the big six between Google, Amazon, and Meta. They're gaining ground while the rest of the market is hit and miss. Uh, Earlier this year, I want to say back in February, NVIDIA was trading for 32 times its revenue, not the sales, the revenue. And this past week, excuse me, end of June, NVIDIA briefly eclipsed Microsoft as the most valuable overall company. So tech and AI are exploding, and you have the herd pumping money into the overall tech world, and it's just jacking prices. So a straight outright investment in technology is not the best place for us. And I mean, NVIDIA, everybody knows. So it's NVIDIA's that shining star. They make microchips that help connect our tech-driven world from point A to point B. And that's great, but a direct investment into that isn't exactly helpful. I mean, you're going to invest a chunk of change and not get much for it. And at some point, maybe it's sooner, maybe it's later, but at some point that bubble will burst, depending on, and if you're buying into it now, you're paying a premium price. When that bubble bursts, it's going to drop like crazy. So if your goal is buy it now, write it out, hopefully sell it before it drops, I mean that, yes, that's strategy. But I would much rather, me personally, I would much rather look at the areas of the market that are just downtrodden and low right now and scoop a bargain. So with the herd pushing money into technology and jacking those prices, they're also ignoring corners of the market, and thereby lowering those prices because they're not interested in it. So supply and demand. They're pushing money into technology, they're buying stuff there, decrease shares, increase price. Or the other corners of the market, not a lot of interest, not a lot of demand, tons of supply, cheaper prices. So if the herd is pumping money into technology, then what's the best long-term play? Where do we go? Wherever the herd is not, and into whatever the Fed cannot print. So bonds for us are the focus right now. And the herd generally hops on the bond bandwagon past when they should be on the bond bandwagon, like they're late to the party. So bonds are our focus. And shortly, or say in quick follow-up to that, are loans and real estate, because they're like bond proxies. They're just downwind and they flow in a similar current. Fixed income, which if you go to Investopedia and just search fixed income, you'll get this long list of opportunities within fixed income. But the most common types are government and corporate bonds. So not every bond portfolio is going to have high levels of fixed income, but high levels of fixed income draw my attention because with the Fed going higher for longer, that should continue to level up profits inside that fixed income market space. Also, so you have bonds, loans, real estate, that's three. Fixed income is a huge factor. Oil, which is the backbone to energy infrastructure, and tech is surging, and that makes sense. So we have increased supply and demand, well, decreasing supply, increased demand on energy, utilities, energy infrastructure. You've got this huge push for electric cars with a non-expanding electrical grid. Like the existing electric grid, regardless of where you live, is having trouble handling the demand of summer. And then you have a ton of people going, buy an electric car because you just plug it in and it works. Yeah, yeah. But they're not telling you, and they're not telling people that when you plug that car in, it's further drawing on the electrical grid. So we have this lagging grid and a higher demand, right? So higher prices. And technology, oil supplies technology. The people telling you that we should go to an oil-free environment are psycho. Oil drives the economy. Every technological advance is an oil-related uh, offset. Computer chips come from oil. Solar panels come from oil. That giant windmill that does horrible things to the environment is an oil byproduct. Your fridge, your shoes, your clothes, your phone, your laptop, right? If you have vinyl floors, if you've got linoleum floors, if you've got pick your plastics, all of those things are oil derivatives. ACs in your car and in your house, pacemakers, crutches, oil derivatives. So for us to go completely no oil is not going to help us at all. And our energy grid needs oil in order to work. So you have this giant draw and you have decreasing supply and you have a higher price. So as tempting as oil is, it's not a great investment right now, depending on when you buy it, one, but also on our metric system or I want to say on our code, I guess you could call it, of investing into closed-end funds. It doesn't hit a lot of our metrics right now. Technology is inside that bubble, and no one knows when the bubble's going to pop. So you have oil surging, you have tech surging. Now, you could argue that that bubble is continuing to expand. So if you can find it at a discount using our system, find it at a cheaper price now, it's just going to continue to expand. So you can get it at a decent price now compared to where it's going to be. I get that strategy, but eventually it's going to pop, and the herd's going to shift from pushing into tech to then shift into pushing into something else. And when that happens and that bubble pops, who knows how far it falls. So pending your strategy, right, depending on how that guides your investments, uh, instead of looking at the promise and hope of things or the who knows how long that bubble's going to last side of things, we invest in discounts, or maybe we buy discounts with a longer game plan in mind. So I'll get to that first. And yeah, it goes back to I have a plan and then I kind of go off pace. right? I kind of go not according to plan. So no, I'll go back. I'll go back according to plan. So this is, and I'll come back to the closed-end fund side of things. This is my Pinterest board or my Pinterest page. We're going off this board, financial memes. And towards the bottom of this board is this meme. And you can read what I say. You can read my title. There's six stocks recommendation to buy while Biden is president. These things. Gold, I mean, you can buy precious metals a lot of different ways. Um, yeah, it's currently a higher price than this. So Martin Marietta, um, let's see, heavy building materials, currently priced at 530, which on my end, I understand why people post memes. I just wish there was a date on them. I mean, one, you could fact check the price of these on that date, but then two, you would know how old it is. So current price, almost 530, listed price on the meme, yeah, about half. They pay a crappy dividend. Canopy Growth, uh, cannabis, currently priced at 6.35, significantly less than what was posted, and they pay no dividend. So there's no reward for owning the company. You're completely at the mercy of the ups and downs. Tesla, yes, you get the overall description, which I would be surprised if you don't know who Tesla is right now. And they pay no dividend. Workhorse, an electrical vehicle company, general equipment, currently at 150. Whew. No dividend. And United Health is all health insurance and services and currently priced at almost 500. And they pay a crappy dividend. Now maybe you bought it really low. Maybe it pays a better dividend now, but it's a crappy dividend. So you don't know why they say, you don't know the justification for these companies. I can I could project that building supplies would increase with inflation, that Workhorse and Tesla are you should invest in them because they're electric based, but I don't know. So I'm going to clear out these tabs. And instead of investing for any random happenstance, we invest with purpose. This is the closed-end fund master list. And it says membership because it is my goal to run a membership or paid for service for this access. But until then, you get all of this for free on my channel. So these are my past videos of closed-end fund information. This is our actual portfolio. This is our actual Roth portfolio. I'll slide it over. You can take a gander, pause the video, and see what you think. This is our individual brokerage fund. Same thing. I will scroll down, and then you can pause the video and take a gander and see what you think. So as you look, we never pay premium or more than it's worth for these funds. We've come close. Some have turned out better than others. But our whole goal is to not pay premium. So this data is based on last weekend, or maybe I'll clarify, it's based on the video for 6:30. If you were to pay $1 and get $1 out of your investment, then the discount would be nothing. For every dollar in, you're getting $1. For every dollar invested, you're getting a dollar of value. If you wanted to pay a premium, if you wanted to pay over, for every dollar in, it's costing you a dollar 0.01 cent. So 1.01. Or you could pay super over and pay $1.58 for every dollar invested. And on the polar opposite end, you could also pay 49 cents for every dollar invested. And for us, we like discounts. Now, just because it's a great discount doesn't mean it automatically is a great deal. It's 40% off. So it's 60 cents for every dollar invested, has a horrible yield, and you're only getting it once a year. We prefer monthly income unless there's a good reason to buy a quarterly company. So all of these are updated. So I update the entire list monthly. I update the blues, the green, say blues, two different blue patterns, green and purple. I haven't seen, there we go. There's a purple weekly. And then I do a weekly video on the updates. So if we rank them by discount and then we rank them by target, the targeted funds have been, every fund honestly has been sifted, and I make notes here and there on different stuff. But the targets, the data is historic as it relates to the individual company. So the way that asterisk system works, so every fund with a triple asterisk is a buy alert because it either has double the historical discount and the discount is greater than the 5-year discount, or it's a newer company and the discount is close. Like FSCO is a newer company. If you're looking at when the company opened, the discount was really steep. So like if this is 0, the discount was really steep, and it's been closing the longer the company stays open. So it's currently at 10. It started out at 23. It currently it's 23. It started out really steep. The discount is going to shrink, and that overall average is going to skew compared to a company that's been around for longer, like the one at the top of the list. So HFRO has been the steepest discount for a while, really since they restructured their portfolio from bonds to real estate. Their historical discount is near 20%. The 5-year, I don't want to read all of this to you. I hate when people do that to me. So based on the current discount, it's a significant discount. Make sense? So I filter these videos and make weekly videos based on the triple asterisks. So instead of taking somebody's random meme as gold or as like stuff you should do, I'm justifying what we should do. So instead of hoping on crazy outpriced materials, canopy, electricity for a failing grid, healthcare, I get, but it's expensive and you're not getting a great dividend to buy it now. And then gold in general, there is a gold-based, precious metals-based fund, but I'm pretty sure it doesn't pay a dividend. So there are different ways you can get into precious metals, but just because somebody says it doesn't mean you should do it, which applies to this video too. I'm completely aware and not prideful enough to just be like, you should take everything I say as gold. But instead of buying stuff willy-nilly and for no apparent reason, and really for not getting any kind of actual dividend, we invest in closed-end funds. So let me stop this for a second. So if the herd is heavy into technology and heavy into AI and pumping those numbers higher, we want to invest where they aren't, and we want to demand a discount, and we want a really good dividend. So we look at bonds, we look at loans and real estate, we prioritize fixed income, oil if we can get it at discount, tech if we can get it at discount. And you can get it at discount, but it's also higher than what it's been. But is and we own a tech fund. Um, as tempting as that tech fund is, bonds, loans, and real estate and fixed income have a higher priority based on the current market and based on the long-term game plan. It's the shiny coin is tempting, right? The new toy is tempting, but is it the best thing for you? It's fun to get, it's fun to play with, but it's not generally the best thing for you. So if we're going to avoid the random happenstance advice, and if we're going to, oops, there we go. If we're going to avoid the random happenstance advice, and we're going to go for a better long-term strategy, bonds, loans, real estate, and fixed income, then this is where we would go. This is where we have gone. So this is the biggest discount. This is real estate, and this is all real estate. Um, the funny thing about this company is you have to search online. And this is their sister fund. You have to search the website and find this website in order to get the current info. The data on Morningstar and even on CF Connect isn't accurate. So feel free to pause this so you can read the screen on yourself. As of March of this year, this is the current data on this company, but it's currently 50% off. So for every dollar invested, you're getting it for 50 cents. That's a really good deal. So when they updated from bonds to real estate, they slashed their dividend in half. It used to be this. Currently, it's this. And that yield is based on that rate at that price. So when their stock price dips, you get a slightly better yield depending on where you buy it. What did I do? There we go. Um, but the discount itself, so as the net asset value, the actual value of the company creeps up, and as that creeps up and the discount closes, if your goal is price appreciation, you want the window to close. That's great. Everybody wants their stocks to grow. We want the consistent dividends. So we target 9% plus, unless there's a good reason to target something else. So option one, real estate. The other real estate option is this one. Okay. And they take a different view on where they invest. Last week's strategy video talked about this company too. I like this portfolio. This company does not go on discount that often. So when it goes on sale, I mean, HFRO is currently on sale at 52% off. When we bought RFI, it was on sale at like 1.6% off or $1.60 off. And not like as of price, okay? But we're looking at that $1 in, $1 out. So when it goes on sale at 1.6%, oh, I said it wrong. So when it goes on sale at 1.6%, we're getting it at like 98%. We're paying 98 cents instead of a dollar. We're getting it for 98 cents for every dollar invested. There we go. But for our technologically driven society, they're not investing into NVIDIA and Microsoft and Google and Meta. They're investing into companies who are going to use technology the most. American Tower, Crown Castle, the cell phone tower providers, Verizon, Comcast, uh, Facebook, True Social, everybody who has a phone and is using those apps, their cell phone provider needs bandwidth and tower space and data storage and management in order to transmit all that data. American Tower and Crown Castle supply the towers and the connectability for those companies to operate. Excuse me. So whereas HFRO is in industrial and commercial settings and some single family homes, That's real estate. But you also look at real estate based on the leasing of cell phone towers to cell phone companies. And that's where we want to be for this technologically driven world because people need cell service and they need data management. The other place we look at first and foremost is bonds. Uh, and FSCO is a super bond company with a high level of fixed income that puts it towards the top of our list. Uh, the data is not complete. It's a relatively new company. They're close to really 2 billion of worth at the moment, or excuse me, 2 billion in assets at the moment. The other bond fixed in company we went with is CIF, and it's on the polar opposite end. So you've got a company with close to 33-ish, 35-ish million, and same thing. Older company, not completely updated on the site. But based on CIF's current perspective on their website, they manage about 35 million in assets versus FSCO is managing almost 2 billion in assets. But each are bond companies with high level of fixed income, and you can get them cheap. So based on the data for 630, 10% off means you're getting it at 90 cents for every dollar invested. CIF, similar. Overall, that historical data is close to zero. 5-year discount is at like 2.3. So we want the discount to close. We buy it cheap. At the most, it goes up to $3. Okay, but we buy it cheap. We use the discount to our advantage. We get a stellar dividend. And as the price goes up, you decide to either hold it long term or you sell it when it's high, take the profit and push it forward. Your choice. Let's see. Research that doesn't help me. So just because somebody makes a pretty meme doesn't mean that it's in your best interest to buy their stuff. You have to do your own research. Are any of these like all of these companies have pretty numbers and pretty figures? But quite honestly, we're investing with a different methodology. All of these are single stocks. We're not going to buy or gold. You can either own a gold ring, you can own a precious metals fund, or you can buy directly into gold through the market in general. But all of these things are single investments. We want a closed-end fund environment where it's a controlled number of shares that really is impacted by supply and demand. Because Tesla, the single stock, or United Health Group, the single stock, if they ever really did run out of shares, they could just go poof, here's your sticky note for a new share, and it does nothing to the overall value. It's a limitless number of shares. It's not a closed system. So in a closed-end fund, if you think of just a list of funds, kind of like a mutual fund, that are targeted or tailored to whatever that fund, to however that fund is oriented and operated, and then you get a stellar dividend. Current average across closed-end fund is about 8.3, meaning that some pay none and some pay crazy amounts. Okay, but you can target your dividend percentage, you can target when it's paid, you can target when it's in it, and all of that gives you better opportunity than just these 6 things, but also having no understanding of why this one company suggests these 6 stocks. None of them really fit the model of what we're looking to invest in. Bonds, loans, real estate. None of them meet those metrics. So as the herd pushes into materials, not really, cannabis, not really, electric stuff and technology, not some, even healthcare in general right now is down. Gold is going up because inflation is high. These are tech-based funds based on, electric cars, electric car supplies. They're tech-based funds. People are funneling money into that market space. It's an elevated price outside of workhorse that seems to have drastically dropped for reasons I don't know because I don't follow them. but we could pursue something where the herd is not and get an outstanding deal on pricing, get it at discount, get a phenomenal dividend, and get something that'll help us out long term as opposed to just right now. So it's not my goal to make a really isn't my goal to blend closed-end funds in the financial in the overall financial strategy, but it happens occasionally. There's just no good way around it. And I'm at a portion or I'm at a point of the uh, meme board where it's a lot more stock comparison, and that's just going to be a lot more stock comparison between single stocks, pricing, and dividends compared to finding those funds in a closed-end fund and doing it from my standpoint a better way. So if you like my content, please consider subscribing to my channel, hit the like button, and then head over to Facebook and join my group there called Navigate Your Finances, where on Facebook I talk about the overall scheme of things, the 12 steps to financial freedom, and I overview the system. I really try to keep outside of the financial strategy that goes into managing the 12 steps. I try to keep the meme reviews on YouTube. I try to keep our closed-end fund system on YouTube because I think everything at once really muddies the water. But if you want the full system and see how it flows together, go to Facebook. If you want more information on closed-end funds, then check out the other playlist on the YouTube channel. And if you want more general ideas about financial strategy and just more commentary, more feedback, then check out some of the other videos on financial strategy here on YouTube. Regardless of where you are on your journey, regardless of how you ended up on this video, if you can figure out where you are financially, right? Like where you are physically might be in an airport, I'm in my house. That's not what I'm talking about. If you can think of where you are financially and where you want to get to financially and what that means in financial freedom terms. Like we want to accomplish our dreams. We want to own property. We want to own rural hunting property and run a conservation-based hunting business. A 197 we want a 1967 convertible resto mod Ford Mustang. But we really want to create financial freedom because if we can create real generational wealth and gain financial freedom, we can gain those other dreams. So we know where we are financially. We know where we want to go. We know where our dreams exist. And we also know there's life beyond that desert island with the X on the spot and that treasure chest. We know where we are, we know where we're going, and we know where we want to go after that. Our job is getting from where we are to where we want to go. And that's the same thing for you. As captain of your ship, you have complete, absolute power to make your dreams a reality. The question is, will you? I mean, whether you're at the helm or not, you're still captain. So your boat will float wherever the winds carry it. Or you can take on the added responsibility and duty of navigating that ship. Now, your job becomes, your job is, whether you take on the challenge or not, your job is to navigate that boat from where you are to where you want to go. Right? And you can go anywhere. And you don't have to go to just financial freedom. You can go to ports of call, you can go to pleasure, you can go to a lot of different areas. But on the financial game of things, your job is to get from where you are to where you want to go financially and not allow the distractions to happen or to minimize the distractions as best you can so you can optimize your results. So if you can figure out where you are and figure out where you want to go, it's a lot easier to get from point A to point B if you know where they exist. Versus if you're just chasing something that doesn't exist, it's going to be really hard to get there. So this game of financial freedom is not a quest for more. The game of more never stops because there's always more. But if you're going forward with the effort to do more with more, it's not like cop out for greed. It's not a cop out for envy. It's not like you're chasing wealth, right? You're not hoping to just suck out wealth from somebody else and add it. It's not that. If you're hoping to grow your wealth and reach a place of generational wealth where you can accomplish your dreams, that means you're ongoingly or continuously adapting your perspective of things, learning as you go, fine tuning as you go, right? Going through your structure and your system and trying to optimize your results all the time. It's this progress or process to do more with more. If you had more and could help more people, that's the goal. It's not the hoarding of more to therefore have more and more and more that you just don't do anything with. It's not that. It's to do more with more, right? And in financial freedom, you have more with more. That's the goal. Help people accomplish your dreams, build generational wealth, help people, and do more with more. And that's where we are. So for you and your boat as captain, you can choose to go wherever you want. You can choose not to steer, and you can have that boat wander aimlessly, or you can attack it with purpose. Captain your ship because your dreams are far easier to reach than what people want you to believe. If it could happen on its own, it would happen on its own. The whole manifestation racket doesn't work. You can think about it all you want, it will not make it happen. Therefore, you have to make your dreams happen. And it's possible, but you got to chase them and not chase them aimlessly, not chase them like you're trying to find a tornado, like trying to follow behind it and not get hit by all the wreckage. It's not that. It's, do you know where you are? Do you know where you want to go? And then you chart your course based on that. So if you want information on that, come find me on Facebook. Otherwise, keep watching my videos and add a comment if you want. So hope you have a great week. I will see y'all at some point. At some point, either on another video or on Facebook. Hope you have a great time. Hope you have a great week. See you later. Bye-bye.